everybody. Welcome to Shock Stock Sunday class. I'm the owner of Culture Shock Investments, Michael Clark, here with you, and we are on Fundamental Analysis Part 2. Remember, this is going to be a lesson for the beginners in stocks. I'm getting live right now on my Discord for my people that are here. But make sure you are taking notes from lesson 1 to now. I believe this is the 5th lesson we are on. So you could go back on the YouTube channel. You can follow us and subscribe to the Culture Shock Investments YouTube channel. And it is going to be under the Culture Shock University playlist. Okay? Stocks for beginners. So go ahead and make sure you're subscribing and following. And we're about to get started right here in a second. I'm going to give people a little bit of time to join. And then we will get rolling, everybody. Okay? All right. Let me send out this invite real quick. And we should be good to go. All right, everything looks good on the stream. All right, let's get it going then. So we have valuation. You know, we have continuation off of part 1 where we were talking about fundamental analysis. A lot of breaking down of the true valuation of a company. That's what you're doing with fundamental analysis. So we're trying to get into the core of the company's true value. And that's why valuation is one of the things you're going to want to be looking at. And this is the process of determining the fair market value of the company or its stock based on its financial performance. Okay, so you have companies that have financial performance that is showing future value based off of what products they have in the pipeline and things that they have getting ready to come out. So you have that will determine the company's value. And then you also have their actual assets. So companies have actual physical assets that they're holding that determine their actual value. So some companies are valued based more on their assets. Some are based more on their maybe items or things that they have in the pipeline as far as products that they may be creating or technologies that they may be innovating on. Okay, so understand that valuation can be determined in different ways for different companies based on how their assets are or what their innovation and production looks like. Let's keep it moving. Why it matters. This helps you avoid overpaying for overhyped stocks. So as you get into seeing the true valuation of a company, you can see if it's being overhyped based on the current stock price, and you'll learn that based on the price to earnings ratio or the price to book value. Whichever way you want to determine that company's value based on how you want to see its true value is up to you, but you also want to lean in what that sector is most likely valued on. So tech sectors, a lot of them are valued on their PE, price to earnings ratio, versus price to book value is more so for like banking institutions and companies like that that have actual physical assets that they're holding that determine their true value. All right. So identifies hidden gems as well that may be undervalued. You may see a company out there that has a stock price that's very low, but you see in their financials, you see that they have strong assets on the books. You see that they have strong products in the pipeline that may be undervalued at the time that, you know, people have yet to realize or recognize, and you can find hidden gems this way doing fundamental analysis. All right. And it also supports long-term value investing strategies. So if you're a long-term investor, this is a good way to make sure that the companies you're investing in are continuing to go up in value or maintain their value as at the same level it was when you invested in them. Okay, you don't want it to be the same exact market cap, but if this is the same rate of growth, as they say, they grow 10% year over year, as long as they're holding that level or above, that continues to be a long-term investment for you. So some of the core valuation ratios that are out there, I was talking about some of them earlier, and one of those is price to earnings ratio. This is a big one. A lot of people use price to earning ratio to see if a company is over or undervalued. Okay, the formula for price to earnings ratio is the stock price divided by the EPS, or the earnings per share. Okay, those numbers are given to you, and a lot of the times the PE itself, with a lot of the platforms out there, you're going to get the PE. The important part for the PE is to compare it to the sector average. So, like I said earlier, if you're investing in an automotive company, you want to look at the average PE for the automotive sector and see where your company ranges on that PE level. If you're in the tech sector, the average PE may be completely different than it is for the automotive or banking sector. And there may be an average PE in the tech sector at around 35, 40, while in banking it's around 12 or 15. But if you see 30 on a tech company, doesn't necessarily mean it's overvalued just because bank companies average at 15. It's just valued based on the sector that it's in. So it's around the average value, then that's good. If it's too high above that 30 number, then you could say, all right, if it's around 70, 80 PE, 100 PE, you could say that company is overvalued. Then you got price to book ratio. Like I said, price to book ratio is better for, well, let's go to the formula first. Price to book ratio is the stock price divided by the book value per share. Like I said, this is provided to you on a lot of the platforms already, but I always like giving you the formula so that if you want to determine these things yourself and you don't have, let's say, the P price to book ratio given to you on hand, you know how to find that information on your own with this formula. All right? And it's like I said, these are for asset heavy sectors like the banking industry or real estate industry, especially REITs, because REITs pay a high amount of dividends. So what they're basing their value based off of is how much real estate or property they own. So a lot of their company's value is going to be based off of how much assets they have ownership over, and that's going to help determine, the amount of rent roll they have coming in or income they have coming in from those properties. So the more properties they own, the higher their value usually is. And then you have enterprise value versus the EBITDA. So EBITDA, we discussed that in part 1, but the EBITDA is the earnings before interest, taxes, and depreciation and amortization. So that's EBITDA. That's short for that, and so you don't want to have to say that whole thing every time. So you just say the EBITDA. And the formula to get this is the enterprise value divided by the EBITDA. That's how you get the enterprise. How you get this ratio here. And this is a popular ratio when there are mergers, acquisitions between companies with different capital structures. It helps you determine the value of each company that is coming together and what they're really bringing together in the merger and what's the true value of that is. So you'll see acquisitions going on a lot of the times now, especially with AI ramping up. You're going to see a lot of those smaller AI companies being purchased by larger companies. And sometimes when those purchases happen, what you'll see is one company go up in value and the other company go down in value. And that is just based on this ratio right here. It's being determined based off of what the capital structure is of each company and how it's being affected by that merger that's happening. So those are some ratios you want to look at. I'm going to show you how those look on TradingView. I'm going to show you where you can find all of these on the TradingView platform. There are many different trading platforms out there, but my favorite to use is TradingView. So that is what I will be teaching you off of. So profitability and return ratios. These are ratios that's going to help you determine the profitability of a company and the return the company has on its investments. Okay, so you have the return on equity. That is the net income divided by the shareholders' equity multiplied by 100. Like I said, these formulas are for you to be able to do this on your own, but a lot of the times you're going to find this exact number or this ratio given to you on these platforms nowadays. So this is pretty much showing how efficiently a company turns its investment money into profit. So there's companies out there that run their core business, but they invest in other companies as well. So this is going to let you know how good these companies are at investing and turning those investments into profit. We just had a big one recently where you had NVIDIA invest in CoreWeave. So now if CoreWeave does poor as a company, it's going to affect NVIDIA's bottom line. And that's going to affect their ROE, their return on equity, okay? So ROE above 15% is generally strong. 15% return on equity. If your investments are giving you 15% return or better, you're usually outperforming the S&P 500. So that's generally pretty strong returns. If you have income return on equity less than what the market is performing, you're probably underperforming the market, and anything lower than that is going to be seen as poor performance. Then you have return on assets. These are physical assets that a company may own. So company, like I said, they own real estate. Banks have different assets as far as ownership over commodities, different bank notes and stuff like that. This is going to tell you what the return is on their assets overall. So the formula for that is the net income divided by the total assets multiplied by 100. And like I said, this is good how well your assets, this is going to measure how well the company's assets are generating profit. So if the company has a good amount of real estate holdings that's growing in equity, they purchase real estate in good areas, like a company like McDonald's, let's say. McDonald's, people believe, is a fast food company, but McDonald's is more of a real estate company than it is a fast food company. And McDonald's, majority of McDonald's value comes from its return on assets. So the equity in the real estate that it owns continues to rise. So they have property in Times Square. They have pretty much property in all major intersections and major neighborhoods around the United States and globally, going to China, going to France, going to Russia. They make sure they plant themselves in the most condensed populated areas where they're going to get the most foot traffic and the most return on their asset as far as equity going up on that property. So that's one way to determine the profitability and return. So a high ROA shows that a company has an efficient use of its resources. So this is what you want to look for when you're looking at the ROA. How efficient is that number compared to the industry average? So there's going to be sector averages for everything, and you want to look at the ROA is usually something that is more broad-based through the market because everybody invests. So there's usually, like I said, a general gauge of how much companies make on their assets, and 15%, as it says, above that is generally considered great performance. All right, so that was part 2. It was a short part 2, but following up on part 1, fundamental analysis. I hope you guys did the assignment that I handed out last time, and you are turning them into my DMs if you are on TikTok or if you're on Discord, making sure you're messaging me and asking me directly since you have direct access while you're on the Discord. So I want you to do a stock valuation practice. I want you to choose a company and find the following things. Is it the stock price? You're going to get the earnings per share. You're going to get the EPS growth rate year over year, the book value per share, and then you're going to calculate these ratios. Of course, you can find them on your own, but I want you to put the formulas into practice and see the number you get, and then go find the actual PE, and then see if your number comes out correct, if you did the equation properly. Okay? I want you to find the PE, the PEG, the price to book value, the return on equity, and return on assets. I want you to find that as well. And then I want you to do the interpretation. I want you to see, based on these numbers that you're finding, is the stock overvalued or undervalued? Okay? Or is it fairly priced? All right? Compare it to the competitors in the same sector. So you want to compare, if you're doing McDonald's, you want to compare them to other fast food companies or restaurant companies. If you're doing a tech company, compare them to other tech companies. Don't cross-compare sectors. Keep it within the family so you get an accurate judgment on if something is over or undervalued. Once you start going outside of the sector, you're going to get thrown off as far as valuation. It's going to make some things seem undervalued that are probably fairly valued, and some things overvalued that are probably undervalued. Okay? So, as always, make sure you follow and subscribe at Culture Shock Investments on everything. Culture Shock Investments on TikTok, YouTube, Discord, Facebook. Make sure you subscribe to the Discord, is where you're going to get the most access, where we do the weekly charting sessions, where I'm live every week, doing live trading with my community and teaching as we go. Okay, we're going to have a charting session tonight at 8:15. If you are a member, you are going to have access to that. If you are on TikTok, I had done a lot of charting sessions for free. The charting sessions now, if you are not a subscribed member to the Discord, will be, I believe, $3 to enter. So that's not much for the value of information you're going to receive through this live. So make sure you tap in. There's going to be a lot of information and price levels provided. 6 of the 9 call outs we hit last week hit. So we're going to go over that again. And let me pull that up actually. Let me pull this up. Before we get out of here, I do want to flash back to fundamental analysis part 1. The 3 core financial statements. I want to give a quick reminder to everybody. The 3 core financial statements I want you to pay attention to. The income statement is the first one. Income statement is going to measure profitability over a specific period of time, a quarter or a year. So make sure you find and pay attention to companies' income statements. It's the first report you want to pay attention to. The second report is the balance sheet. You want to look over a company's balance sheet. This is provided to you, like I said, on TradingView. It's provided on a lot of these platforms that people use now. A lot of this information, this is public information. It's not hard to find this on any company. You can find it on Yahoo Finance, TradingView, E-Trade, Robinhood. A lot of these platforms are providing this information to you, okay? So you want to get a balance sheet. This is going to give you the snapshot of the company's financial position at a given time, how healthy or unhealthy their finances are for the quarter, okay? And then you want to look at their cash flow statement. Cash flow statement is good to see how liquid a company is, how much money they have on hand right now, all right? This is going to let you know if a company is struggling, if the money is tight, if they're operating out of debt and on credit most of the time, or if they have cash sitting on the sideline available to make investments or acquire smaller companies, okay? So don't forget those three core financial statements. Make sure you lock in and study those. We're going to tap into TradingView really quick. I want to go over Microsoft. I want to show you, if you go into TradingView and you open up the information, the base information for a company, you can click on financials. The overview is going to give you overview information on everything, pretty much breakdown. You may get some of the ratios we were talking about in here. But if you really want to get the information, you got to go into the financials. You dive into the financials and you want to go into the statistics, okay? So in the financials, then you go in statistics and you're going to see a lot of these ratios that we were talking about through these 2 parts of fundamental analysis, all right? So you're going to go in and you're going to find these ratios and you're going to compare these ratios to other companies in the sector, or what you find out the sector average is. And then that's going to help you determine whether a company is overvalued, undervalued, or is valued just right at the time. That'll help you determine whether you need to be buying a stock, selling a stock, or just holding a stock. If a company is a little overvalued, it may be time for you to take some profit off the table until it pulls back and finds a fair valuation. If a company's undervalued, you're going to want to be loading up on the stock because you know it has room to grow into its valuation and is currently not valued at the proper price in the stock market. If it's fairly valued, then it's a company, if you own it already, you probably just hold on to it and wait to see what comes out in the next earnings report. Okay? All right, everybody. So you'll see all these ratios in here. Like I said, price to earnings ratio, price to sales. They got price to book ratio. The price to book ratio, 9 times out of 10, is going to be lower than the price to earnings ratio, because this is going off of the book value of the company, what the company is actually reporting that they earned in the most recent quarter. You know, so the price of the stock compared to that actual value on the book is usually going to be lower than the price to earnings, because the earnings reflects what they are seeing in the future value. Earnings is always something based on, price to earnings is always something based on future value, where people see the company going into the future. So that's why a lot of the times the price to earnings is much higher than the price to book value, because people that are doing price to earnings ratios, they're comparing that to where they are having the earnings reports come in. So the earnings a lot of times for companies, like I said, are based on future production, based on what people think the company is going to be doing and projected to be doing, versus the price to book is what is actually have done and what the price of the stock is now compared to that value, okay? And then you have the profitability ratios that we were talking about right here. Return on equity percentage, return on invested capital, the EBITDA margin percentages. So you want to go ahead and make sure you go and mess around with this and dive into these reports. And it's going to really give you deeper understanding on how a company is really valued at the time. Not something based off of what you hear on a TikTok post, not something based off of what you hear on TV. you're going to be able to take that information and now go into the stock and say, okay, that information is true, or no, that information is not true. The company is not really has that much potential ahead of it. It's actually overvalued right now and it's looking like a pullback. Or it's like, oh wow, that's a good call out. This company's undervalued and these people spotted a good opportunity. They have some good products in the pipeline, etc., etc. All right, so this is part of that homework you have to do if you are going to be analyzing companies for the long term. And it seems like a lot at first, but once you have done the homework on, like I said, your first 2 or 3 companies that you're going to be using to start off your portfolio as a beginner investor, you're going to have the information, you're going to know it, and then it's not anything but maintenance. You're just going to be tracing it every 3 months when they put out the quarterly report, and that's not that often. They have to look at these numbers. Okay, so make sure you're in the charting sessions. If you're not subscribed, like I said, make sure you subscribe to the Discord and to the YouTube channel and to the TikTok. Make sure you're following if you're not following. Share the space, share the information. We are here to share the wealth of information and knowledge. So let's make sure it gets out to the black community, because we need to build up our ownership in assets and start developing true financial freedom. All right? And stop looking for it to be given to us. We could go take it. It's out there for it to be taken. So let's go get it. All right, I'll see you guys